PK52, the Saturday morning meeting. I'm a little bit ahead of the curve here, but let me throw something out that's coming in the near future. So we've been selling cars to customers now. So the pandemic started February, March of 2020. So once we got past the end of 2020, the chip shortage and everything, we've been selling customers cars at way over MSRP or way above extra clean retail book. So these customers are going to come back in a negative equity situation, especially customers that have done a 72 or an 84 month note. So some of you know I go back a long time in the car business. In the early 90s, from the early 90s through the mid 90s, leasing really came on for the car business. It was a giant thing in the car business. The reason is the interest rates went up. The interest rates are going up right now. History is repeating itself. Interest rates kept going up, and what happened was the price of a car went up a little bit, but the price of the payments went way up. Payments on a house went way up, and people couldn't afford the cars. And I'm going to show you some ridiculous numbers right now based upon where we are now. But the average price on a 60-month note on a Camry LE was about $425 a month. And that got to the point where the customers were uncomfortable with a 4-cylinder Camry for $425 a month. We had some lease programs going. Subvent it for a month or so for $199 a month. And you can close a lot more people at $199 than you can $425, even though it was a lease. Without the subvention, though, the lease payment leveled out to about $300 a month. So the difference was $425 for a 60-month retail note or $300 a month for a 36-month lease. Most of you can do the math. If I drop this down, that's $125 a month I'm paying less on the lease. Some people say, well, I really want to own my car, but then you start doing $125 and you say, no, you're driving this car in the same place, picking the kids up from school, go to the grocery store, doing everything you normally do. It's the same exact car, but over the first 36 months, and that's when people would trade. Once the warranty started going, the comprehensive was gone, and the car started needing service, and within that next year, if you bought the car, that a lot of service came up, they would just trade the car and get a new car with a new warranty. And so 125 times 36 is $4,500, and it's really hard for people to understand that. So what I've done is I've got a tricky little chart here. So I would explain to the customer in several terms. I said that's $4,500 in payment reduction, money you didn't pay. That's $4,500 in payment savings. That means you did not pay that. You've got it still in your pocket. That's $4,500 in money you didn't have to spend to drive the same car, or $4,500 in money that you've actually saved. So whatever term that worked for them, they were driving the same car for $4,500 less. I love it when a customer brings a car in trade and you get to tell them they have equity. You have $1,500 worth of equity, and they go, yes. That means my payment's going to be lower on the next car. And then I would look at their old paperwork for the car, and I found out they put $5,000 cash down. So they didn't have $1,500 worth of equity. They had negative $3,500. They bought their negative equity with their $5,000 down. Now they only have 15. But you know what? They didn't figure that out. It's kind of interesting. But there's no way you're trading a 3-year-old car in with a 60-month note and having $4,500 in equity. I'm giving you that up front with a lease because that money you don't spend. You still have that money. Hard for people to understand, so I chart it. So I use the old second grader or third grader charts. And if I'm writing this down, I use money over here, 5,000, 10,000, 15,000, 20,000, 25, 30, and I go all the way to 40,000. Down here I do the months, 12 months, 24 months, 36 months, 48 months, 60 months. And so what we do is we figure out how they bought the car. Let's say they're looking at a $30,000 car in a year or so. So the car's selling price is $30,000. That is at 0 months or $30,000 today. And that doesn't matter whether you buy the car or you lease the car, the selling price is $30,000. So then I look at the customer and I say, let's say you keep it 3 years like you did your last car. The average, so 3 times 15 is, times 15,000, 3 times 15,000. And I've had customers come back and go, well, I'm not really good at math in my head. But an hour later, they're going, well, Casey, I think the payment's too high. I go, how would you know the payments are too high? You're not good with math in your head. Had that conversation multiple times. So I help them. So 3 times 15,000 is 45,000. I got 45K and I circle it. I'm notorious about doing 15,000 mile lease because the customer's in a lot better position at 15K versus 12K. So now I've got this all set up and I say, so let's reverse it out using my chart. The car's 3 years old now and you put almost 50,000 miles on it. You initially paid 30 for it. Half is about 15. So what do you think it'd be worth? Should be worth at least? And they say 15 and I just walk it right over here and I put an X right there above 36 at 15 and I connect these two and I write cost of use. You can call that depreciation. I just don't think that's a great word. Cost of use. So watch this. This is what it costs you to use it. How much it cost me to use it? 15,000. How much is it worth at the end? 15,000 because I've got that X. It doesn't matter how you get the vehicle, gang. It's going to be worth what it's worth. I think I can prove this. If you pay cash for the vehicle, it's going to be worth what it's worth. If you finance the vehicle, it's going to be worth what it's worth. If you do the Toyota Touch, and I call it the Toyota Touch or the TFS lease, it's going to be worth this, except Toyota will guarantee the future value. If you pay cash or finance the car, it may end up being worth a lot different than what you think. Over here, they put that actual number to the penny on your contract and you are guaranteed that money. And I'll show you what your guaranteed is. I call it a guaranteed future value. It's also called a residual. Here's the problem we're going to have a year from now is these people come dragging this negative equity in, and they're going to have a lot of negative equity. They understand they bought a car at a peak demand time, and they've got a lot of negative equity. Toyota will allow you to go anywhere from 120% to 130% advance to MSRP. So that MSRP, I'm selling the car at $30,000. They'll now advance $39,000. Why do I need that advance? Because the customer drags in a lot of negative equity. There's a lot of cool stuff that happens right now. All right, so now I've got to change my X to put it right there. Now, instead of it going down here to the X here, I've got a little bit of an interest curve here. And so I end up owing more than the 15,000. That's what people call negative equity. And that's the reason they're in the situation they're in right now, because they owe more on the car than what the car is actually worth. Let me show you something really cool about a Toyota Financial Services lease. Doesn't matter what the starting price is, there's going to be a guaranteed future value residual. So instead of that being a curve, it goes right here and goes straight down here. So at the end of the lease, even though you didn't advance, there is no negative equity. The lease relieves the negative equity. So you got the customer out of negative equity, and at the end of 36 months, they're break even, they're not upside down. So I love this piece. So now if I look at this and I say, well, what are my options? Well, let's do the options real quick. Option number one would be equity. The reason why somebody likes to buy their car is they like to trade it in at the end. So I'll change the word equity to trade in. Now we understand that Toyota wants their 15,000. That's the example we're using right now. Let's say, for example, the car's worth this. Let's say it's worth 18K. That's what it's worth in an open market. Well, so the used car manager appraises it at 18K. They pay off my 15K, and I get to use that $3,000 worth of equity to buy down the payments on my next car. That's exactly what I would have tried to do on a retail, but the problem is you also trade in negative equity, so you trade in like minus 3,000. So I've got that equity or trade in. Also, I could do profit. I like this one. My next door neighbor wants this car for their kid, and I said, I'll sell it to you for 18. I pay off the 15. Now I've got to pay the sales tax. The state's going to get their sales tax. So 15 plus the sales tax, I sell it for 18. I pocket the money. They don't care. Toyota doesn't care. They just want their 15. The next one is the love option. And a lot of people are doing that right now. It's irritating a lot of used car managers because 3 years ago, the customer leased their 4Runner when everything was selling for less money and their residual was a lot lower. Now they're coming in and they're going, if I get another 4Runner, I got to pay what? Well, I'll just buy mine out from under the lease, and they're buying theirs out right there at the 15 or whatever it is, and they're walking away. They're getting a lot more vehicle because the market is higher than what the residual is, so they can buy their vehicle. There's one other option. I've got to change colors for you. It's called walk away. Right now, gas prices are high. I don't see them coming down. We've got vehicles in our lineup that get 20 miles per gallon. 3 years from now, the problem is some of these cars will get double the gas mileage. And now that means the car that gets less than 20 miles per gallon is not worth 15 anymore. Let's say the value drops down here to maybe 10. So now that's a loss right there. The beauty part about a lease is Toyota's guaranteed you the 15. So if the market has changed, it wasn't your fault the market changed. If the market changed, Toyota pays the loss and you walk away. The only wrinkle in this that's going to happen multiple times is when the customer objects to the miles. They go, I drive too many miles to lease. Well, first of all, you have to examine that. I've gone out to people's trade-ins before, and it's a 3-year-old trade-in. It's got 40,000 miles on it. They don't even drive 15,000 miles a year. So I go back in and I go, so when did you move? They go, well, I lived in the same house for 20 years. And so your new job, is it further away from the house? No, I've worked the same job for over 12 years. You don't even drive 15,000 miles a year, so this is not going to affect you on miles. It's crazy, though. They get scared about that. But the mileage penalty for Toyota is only 15 cents a mile. If you drive high miles on a car, it reduces the value of the car. That's just a fact. The more miles you put on the car, the less it's worth. In a lot of cases, the mileage depreciation is more of a cost than the 15 cents a mile. That's another story. I can show you at another time, but that is actually the facts. So what happens here is now they try to overcome you with miles. Well, the only time that I would pay a mileage penalty is if I walked away, the one in red. Watch equity. I'm trading the vehicle in. The used car manager is going to pay off the 15, and all Toyota cares about is 15. I don't care how many miles a car has on it, as long as they get their 15. If I sell my car to my neighbor and I pay Toyota the 15, they don't care how many miles the car has on it because I'm paying off the 15. If I buy the car and pay the 15, they're not going to charge me for miles. I'm buying the car. So the only time that you would ever pay a mileage penalty is if something happened to the market and it's more beneficial financially for you to pay the 15 cents a mile. I hope this helps because we are going to really need this, and you need to start practicing this, because my anticipation is as people come in with more and more negative equity, instead of Toyota doing the $12,000 cash back rebate, everybody like the domestics, I think Toyota will start putting money back into the bottom of the deal and start doing leases so we control our Toyota cars at the end. PK52, the Saturday morning meeting.